Welcome back to Margin. News broke this week that year-over-year inflation has surged to 7% for the first time in 4 decades. Now, if you're unsure what this means, it's a measurement of the cost of consumer goods. Now, this is otherwise known as the Consumer Price Index, or CPI, and it's a critical component of measurement to find out whether household expenses are expanding or contracting. Now, based upon this, we are going to look at 3 components that affect all of us based upon the consumers, the workforce, and the economy. But then I will provide some suggestions on how to prevent letting rises in inflation eat your lunch, both figuratively and metaphorically speaking. So Fox Business had an explanation of why inflation is seemingly going full steam ahead, with months of continued growth. And they stated that the current rate of U.S. inflation stems from the robust economic recovery after the unforeseen economic downturn caused by the pandemic. In the early stages of the pandemic, businesses halted operations and unemployment skyrocketed. But the American economy swiftly regained strength amid emergency measures from the Fed, stimulus spending by the federal government, and vaccine distribution. Consumer demand for goods and services suddenly spiked as Americans were given stimulus cash, but businesses struggled to keep up with demand after being hobbled by the economic disruption. This resulted in supply chain issues, labor shortages, and increased wages, and businesses had to increase prices to offset higher operating costs. Increased government spending also plays a part in inflation. Now, this core CPI, which has seen its fastest increase since June 1982 when inflation hit 7.1%, looks at lesser volatile aspects of consumer needs. Now, why this is important is that according to the Wall Street Journal, it marked the 3rd straight month in which inflation exceeded 6%. While this is an overall look at varying categories, while removing those that are volatile like food and energy, we are all experiencing the impacts of inflation. Now, unless of course you are living off the grid like a mountain man, or the Amish. Maybe you're living in a commune like a monk, or you have been insulated in some other way. We have all been affected by this inflation. So looking at the numbers a little closer, the Wall Street Journal stated that prices of used cars and trucks soared 37.3% in December from a year earlier, while living room, kitchen, and dining room furniture jumped 17.3%. MSN Money stated that energy costs are up 29.3% since December of 2021. In addition to this, there has been a 41% cost increase on fuel, oil, and a 24.1% increase on utility gas services. Now, this is just to name some of the aspects that have been affected or heavily affected and impacted by inflation. So all of these components are feeding into the prices that we're seeing as consumers. Now, if you owned a home prior to, let's say, late 2020, you have likely experienced some nice gains in the value of that home. If you bought a new vehicle in the past few years, your now used vehicle may be worth more than you originally purchased it for brand new. And if you invested in a little internet money like Bitcoin, you're probably feeling a bit emboldened at your investment strategy at this point. That said, the market is a bit atypical right now. Now, this meaning that inflation has surged prices on many items that in a stable or balanced economy should not be able to accomplish such asset values. So from a consumer standpoint, I went to Costco this week for some groceries and picked up a large clamshell of package of fresh organic strawberries. Now, I went from the back of the store all the way up the front with my groceries, got up to the self checkout to find that those strawberries were $13. Now, I think this is the first time on the grocery side that the impact of inflation really hit me. It was really surprised me. Now, I stood there at the checkout and I was like, okay, wait, what? Like, what happened here? How in the world are these this expensive? Now, thinking they are not my fruit of choice anyway, it's not necessarily an item I would buy very often for the aforementioned reason anyways. So they could have steadily increased over a number of months or maybe even a couple years, and I just wasn't aware of it. And I was surprised nonetheless. As for the workforce, an article by MSN Money stated that high inflation is hurting both workers and their employees, as even a nearly 5% rise in average wages over the past year has failed to keep pace with prices. Companies, meanwhile, face a tight labor market in which they are having to bid up wages to attract and retain talent, while also being forced to pass higher prices on to consumers. So what has been initially deemed as transitory inflation may be here to stay, as wage increases are much more difficult to make adjustments on down the road, after the shift has already been made and the people have already been impacted by those wage increases. The December employment report signaled continued tightening of the job market, with the unemployment rate dropping to 3.9% from 4.2% in November. The Labor Department said giving workers additional leverage on pay. So this is further worsening the scenario or the situation that the inflation is here to stay. Now, we have all seen the rise in product costs, the rise in personnel costs, but what about the overall economy? Now, Deutsche Bank's Jim Reed stated that the real Fed funds rate in December was around -7%, which for reference is lower than at any point in the 1970s, when the lowest the Fed funds got in real terms was around -5%. This meaning that in real estate interest rate terms, we are in the negative category. So with the press release from the Fed came news of what would be viewed as aggressive interest rate hikes in order to curb inflation this year. What this means is that the government will increase the cost of money from a standpoint of what it costs to go get a loan on a home or a vehicle, which in turn will slow economic growth overall. So what this means is that the government will increase the cost of money from a standpoint of what it costs you to get a loan on a home or a vehicle, which in turn will slow economic growth. Now, it's more complicated than that, but this means that the economy will most likely either stabilize or even shrink in the months and years to come. So for years, the customarily low interest rates that we've enjoyed has helped fuel the economy by providing cheap money. But this cheap money, amongst a number of other factors, has fueled inflation as well. So with all of this information around the consumers, the workforce, and the economy, what should you do? What should you do as a consumer, as a participant in the workforce, or as a contributor to the greater economy? Well, the verdict is still out on where is the safest place for a stored value, being that the US dollar is rapidly being devalued. But I would recommend that you start with your own household. Do you operate off a budget or a plan to spend? Do you know where your money is going to go to before you receive it? Or are you just wondering after the fact where it all went? Now think about using this first month of the new year to build a budget. And over the next few months to really refine that budget. Now, I have a number of resources on this that will help you through the process, and I will link those in the description. But go ahead and start there, because I believe that that area will give you the most momentum in counteracting the impacts of inflation. Now, you'll get a raise immediately by doing so. Now, once you know your money and where it's going, you will want to look at restructuring any high interest debt into lower interest products, especially those that have variable rates. Now, it looks like the interest rates that we will see in the months to come or years to come will be less favorable to what we've seen in the past or even in the most recent times. And so I would encourage you to go through the process of really figuring out what needs to be restructured based on that knowledge. And finally, take a look at your household income and income sources. With the Great Resignation playing out before our very own eyes, this may be a perfect time to restructure your compensation by asking for a raise, polishing that resume, or adding a second job or maybe a side hustle of some kind. So more to come on the Great Resignation in the next episode. If this information is helpful to you, explore the Margin membership, where me and my team will help you take the information you're learning and apply it to your life and your finances. I've built an interactive course that allows me and my team to come alongside people like you to help you revamp your finances and build margin into your life. Click the link in the description below for more information.